join today's webinar, Credit Prospecting Because You Can't Afford to Let Great Loans Slip Away. I'm Jackie Pearland. I am a sales representative here at LKCS. And before we begin, I just want to get through a few housekeeping notes. This session is being recorded, so we will share that on our website and our YouTube channel afterward. Also, the lines are muted, but feel free to submit questions in that questions panel and that GoToWebinar toolbar, and we'll get those addressed during the Q&A at the end. Okay, I'd like to begin with a quick overview of LKCS. So just a little fun piece of our history is that LKCS was founded in 1961 by Norb Dudek. He was actually laid off, so with a $1,500 loan from a local credit union, he started the company. And we're actually proud to say that we still partner with that same credit union today. That story reflects something important though, long-term relationships that are built on trust. So supporting financial institutions isn't just our business, it's actually where our story began. That same philosophy continues to guide how we actually operate today as well. Since the beginning, we've been guided by 4 core values: best service, high quality, fast turnaround, and fair pricing. So those values still shape how we support financial institutions nationwide today, across marketing, digital solutions, print and mail, and statement processing. While our services have evolved over the years, one thing hasn't changed, and that's that we want to remain focused on helping financial institutions like yourself grow strategically and stay competitive. And that's exactly what today's conversation is going to be about. So in today's lending environment, if you're waiting for borrowers to come to you, there's probably a good chance that those loans are going somewhere else. Borrowers today are they're shopping faster, they're comparing more options, and they're often making decisions before you even know that they're in the market. So I think the question becomes, how do you identify those opportunities earlier and bring those back to your institution? So today we're going to walk through 3 strategies that will help your institution do exactly that. First, we're going to talk about personalized offers through variable data printing, how they can drive higher response and engagement. Then we're going to move into credit prospecting, how to proactively identify those qualified borrowers before they apply. And then finally, we'll talk about campaign suite, how digital follow-up and automation can actually extend the life of your campaign and it significantly increase your conversions. All right, let's begin with the first strategy, personalized offers. Because one of the biggest differences between a piece of mail that's going to get ignored and one that gets opened and acted on is going to be how relevant that feels to the borrower. So that's exactly what variable data printing, or we call it VDP, it allows you to do that. So variable data printing allows each mail piece to be customized for the individual recipient. So basically, instead of just sending one generic offer to everyone, each borrower is going to actually receive a personalized loan offer based on their credit profile. And the content can change from one recipient to the next. So things like the loan amounts, estimated savings, specific offers, interest rates, and even the messaging itself. It's that level of personalization that makes the mail piece feel really relevant and engaging to the borrower. And because it's tailored to that individual, these campaigns usually have higher response rates compared to just those generic one-size-fits-all mailings. But before we talk about why this works so well, let me show you how variable data printing actually looks like in a sample campaign. Okay, so this is a sample auto loan prospecting letter. What you're seeing here is not just a standard marketing piece though, it's actually variable data print in action. So every highlighted area in the yellow arrows can be personalized for the recipient. So you'll see on the left there, you have the mailing address, the greeting, and the response path. Then if you look on the right side, we've got the personalized offer details, the loan information, as well as that estimated savings amount. And even towards the bottom, you can see that variable elements like the expiration dates are also there as well. So basically within a single mail piece, all these fields are going to be dynamically generated using credit and data criteria. So it's going to allow each offer to feel relevant without having to manually create multiple versions. And it actually doesn't stop with the numbers. There's visuals, messaging, branding, imagery, overall creative direction. It can all be customized to basically align with your institution and your campaign goals. And here's where it becomes even more powerful. VDP actually allows you to run multiple loan type offers within the same campaign mailing. So each recipient still receives one clear, relevant offer, but they can actually vary based on their profiles. For example, one individual may receive an auto refinance offer like this one we have here. Another one may receive a home equity offer, and yet another one could receive a mortgage opportunity, and that's all within the same campaign. So while each envelope contains just one tailored offer, this approach just allows you to reach that broader segment of your account holders and your prospects in your service area without creating separate campaigns. And in most cases, it's just additional artwork is the only additional cost. The same personalization can actually, doesn't just stop at mail. You can extend it into statements and emails, so you're creating like a consistent experience across multiple touch points. So now that we've seen what it looks like, I want to talk about why this level of personalization actually drives that stronger engagement and that response. Okay, so why does this work so well? It's that relevance that drives the response. So when borrowers receive an offer that reflects their financial profile, that loan balance, if they see that potential savings or that they're even eligible, it's just going to feel intentional rather than mass produced. It's that level of personalization that's going to increase that engagement. It's going to build credibility, and it's ultimately going to improve your response rates. It's also going to allow your institution to market more efficiently. So you can focus on those qualified borrowers instead of just casting a wide net and hoping. The result is going to be stronger ROI. You're going to have better use of your marketing dollars, and you're going to have more funded loans for your institution, which is what we want. And that's where the credit-based targeting actually becomes the engine behind it all, because personalization only works if you're sending the right offer to the right people. And that's exactly what credit prospecting allows you to do. It's going to identify those qualified borrowers before they apply. So credit prospecting is a proactive marketing strategy. It uses real credit bureau data to target individuals who are already meet your lending criteria. So whether they're existing account holders or new prospects in your service area. Instead of waiting for borrowers to come to you, you're just identifying those opportunities earlier in that lending cycle. It's going to allow you to uncover refinance opportunities and new loan opportunities. And it's also going to let you deliver highly targeted pre-approved credit offers through channels like the direct mail, the email, or the statements. And it's because it's built on that pre-screened credit bureau data that these campaigns are fully compliant. They're going to include that required pre-screen and opt-out language needed. So ultimately, credit prospecting is going to help ensure that you're reaching that right audience. You're going to have the right offer. It's going to link to that stronger response and more funded loans for you. Let's take a look at the data behind it, because that's what's going to make this actual level of targeting possible. So at the core of credit prospecting is going to be your pre-screened data. This is what's going to allow you to identify individuals who are already meeting your lending criteria using that real credit bureau information. So that just means you're not guessing, you're actually targeting qualified borrowers from the start. Again, pre-screening campaigns can support both that new loan acquisition and refinance opportunities. It can be used across products like auto loans, mortgages, home equity and HELOCs, credit cards, and personal loans. Because this targeting is actually built on the actual credit attributes, your marketing is going to become far more efficient. It's going to focus on those buyers who are more likely to qualify and respond to you. So that's what drives that higher response rate and that better return on investment. So let's take a look at why this data is so powerful and look at why credit bureau data matters. Okay, so credit bureau data is critical for one simple reason. Not every lender reports to the same bureau, and not every single bureau has a complete profile on every borrower. So basically, if you're just relying on one bureau, you're automatically going to limit your reach. By sourcing from those multiple bureaus, you're going to significantly expand that pool of your qualified leads. In fact, if you look at the visual here, you can see moving from one bureau to two can actually increase your reach by roughly 40%. And if using all 3 bureaus, you can actually lift that by 70% or more. So that's pretty big. That's just why multi-bureau sourcing makes such a meaningful difference when you are using credit prospecting. And while the bureau data is really the foundation, we can actually layer in additional insights, things like demographic, property, valuation data, when it makes sense, just to kind of further refine your targeting. And I should say the goal isn't just more data, it's better targeting, built specifically for your financial institution. We do maintain strong partnerships with the major credit bureaus, so we're going to help you maximize that campaign reach while also maintaining that accuracy and compliance that's needed. Before we move into the execution, I do want to briefly address an important regulatory update that's getting some buzz around. So basically, there's been a lot of discussion recently around the Homebuyers Privacy Protection Act. It officially went into effect on March 4th of this year, so just recently. What it does is this new law restricts the use of mortgage inquiry, which is often called trigger data, in certain marketing campaigns. Those are going to include your pre-screen, your trigger-based, and your lead generation campaigns. But it's important to clarify something here. The law isn't about what product you're marketing. It's about whether mortgage inquiry trigger data is being used in your targeting criteria. So basically, under this updated framework, mortgage trigger data can only be used when a firm offer of credit is made and the lender has a qualifying relationship with the customer, such as originating or servicing the mortgage, or maintaining an active account relationship, or having documented consumer consent. So basically, as a result, mortgage inquiry trigger data can't be used broadly as a general marketing filter, but it's important to say that mortgage inquiry triggers are only one data point. There's still hundreds of other credit and demographic attributes available that you can still build those highly targeted campaigns, including incoming and alternative data sources as well. Under this new law, updated bureau agreements and the certifications are also required for institutions that are going to access this data. If you're an institution that's previously used mortgage trigger strategies, we've already aligned our processes to help guide compliance under the new framework for you. So ultimately, mortgage marketing, it's not going away. It just simply is going to require a more thoughtful and compliant data strategy moving forward. And I think this is really where partnership really matters. So your institution maintains control of like the strategy and compliance decisions, but we're going to help guide that data strategy and that campaign execution within that bureau framework to help you. Okay, so earlier we just talked about the power of pre-screened data, and this is really where strategy comes into play. The advantage here is very simple. You're going to stay in control. So your institution is actually going to define the targeting and lending criteria. That's going to include things like that credit score ranges, loan balance thresholds, the payment history requirements, and the specific loan products that you want to promote. This is just going to ensure that every campaign aligns with your lending guidelines and your risk tolerance. Now on our side, the LKCS side, we're going to support that back-end execution. So things like sourcing the credit bureau data, to aligning the campaigns with the bureau requirements, to supporting your campaign performance when tracking is in place. So the model is pretty straightforward. You're going to control that strategy and we're going to support that execution. And that's, I think, what makes launching effective and compliant campaigns both simple and scalable for you. So now once your criteria is defined and we've got the back end in place, the next step is going to be understanding what makes these campaigns true firm offers of credit. Okay, so firm offers of credit are often referred to as pre-screened or pre-approved offers, and they are the foundation of credit prospecting campaigns. Because the credit bureau data is used, all campaigns do have to comply with that Fair Credit Reporting Act, or the FCRA, and we're going to, again, help guide you through that process. But it's important to say that the marketing materials must clearly indicate that the recipients were pre-qualified, pre-approved, pre-screened, or pre-selected. You're going to hear those terms used interchangeably, but any of them is going to satisfy that bureau requirement. Campaign materials must also include minimum qualified credit amount. Now that amount can be presented in a couple of different ways. So if you want it to appear directly in your main message, for example, you've been pre-approved for at least 10,000, that's great. Or if you prefer like a stronger headline, like up to 80,000 available, that minimum qualified amount can be stated even within the disclosure section. So the key requirement is simply that that minimum amount does have to be disclosed, not necessarily where it appears. It just allows flexibility and creative messaging for you. Campaigns must also outline the key terms, conditions, and eligibility requirements, including situations where credit may ultimately not be extended. So you have to, if you're not going to, you have to also state that. Required disclosures and pre-screen opt-out language must also be present. And again, LKCS does help guide you through that campaign structure and kind of helps you just guide you through that whole process. So ultimately, firm offers of credit are going to provide that compliance framework for you. And credit prospecting campaigns is actually what's going to bring those offers to life in the market. So let's take a look at those. Okay, credit prospecting campaigns. Here's where you're going to turn your strategy into action. So using that real credit score data, you're going to be able to deliver those targeted pre-approved offers of credit based on qualifications and not guesswork. Again, these campaigns can reach your existing account holders and your new prospects, again, meeting your defined lending criteria there. Again, you're going to control those qualification rules, so the things like credit score ranges, loan balance thresholds, product focus, and any risk parameters, you'll be all in control of that still. Campaign delivery can take many forms too, from direct mail and email to statement messaging and outbound calls, just kind of depending on what strategy you want to go with. I do want to say though, if outbound calls are part of that strategy, your team would just handle the dialing. We would support you with like targeted lists, timing, scripting, things like that. Credit prospecting is highly flexible too. Your institution can often, a lot of them we see combine multiple channels just to kind of reinforce that message and increase that response rate. But right now I want to take a look at a few campaign types that institutions are using successfully. So these are just some of the most common credit prospecting campaigns that we see financial institutions execute successfully. We've got the auto refinance and vehicle loans. You've got credit cards and balance transfers. You've got home equity and the HELOCs. You've got personal loans and mortgage loans. But just to let you know, this list isn't meant to be limiting by any means. These are just a few examples. So the opportunities basically are going to extend far beyond any of these categories. I think the key is just to be creative and strategic. The real opportunity is going to be building campaigns that are going to align with your market, your growth goals, and your risk strategy. And I should point out that every campaign can be fully customized. So from credit score ranges, loan balance thresholds, those rates, qualification criteria, just to ensure that everything is going to align again with your lending policies. And as market conditions change, these campaigns can be adjusted really easily. Just help you stay competitive, help you stay compliant. Let's look at a few of these real campaign examples though, and some of the qualifications and that criteria that are behind them. Okay, so these are intentionally very simple examples. Just wanted to kind of show you how auto refinance campaigns are typically structured. So you're going to see the first example here on the left as lease expirations. Here we're just identifying borrowers with a FICO score of 640 or higher. We're excluding individuals with recent auto delinquencies or those repossessions. And then you'll see we're layering in timing, targeting consumers with only 1 to 3 months remaining on the current lease, which obviously is going to signal they're approaching their next vehicle financing decision, so it's a good time to get them. Now on the right side, you'll see a loan payoff scenario. Again, we're going to start with the FICO threshold of that 640 or higher. We're going to exclude any auto delinquencies and repossessions again. And then from there, we focus on borrowers with a current loan balance greater than $5,000 and ensure that also there's a projected monthly payment savings, because that potential savings is typically what's going to motivate someone to refinance. And of course, these can all be adjusted. They can be layered further based on your institution's lending strategy or your risk tolerance. Okay, again, a few more simple examples just to show you how they're structured. On the left, we have a credit card balance transfer opportunity. Here, we're just identifying consumers with FICO scores of 620 or higher who are carrying revolving balances greater than 10,000. And we're also looking at that credit utilization between 30% and 70%. This is typically that meaningful balance, but you're still maintaining that reasonable credit health, which is what you want. We're also going to exclude borrowers with current late payments to ensure that the campaign is just focusing on those responsible borrowers who probably could benefit from consolidating balances at a lower rate. On the right here, you'll see a home equity or HELOC campaign. Here, the targeting is actually going to begin with a little higher FICO threshold of 680 plus. We're then going to identify homeowners with available equity greater than 20,000 who do not currently have a home equity loan or HELOC. The campaign is going to be typically structured with a loan to value ratio of up to 80%, which just helps institutions kind of expand that lending while maintaining appropriate risk parameters there. And again, with like the previous example, these criteria can always be adjusted. They can be layered, based on your strategies, your tolerances for risk. So far, we basically covered the strategy. We've covered the data, the targeting, and that compliance framework. Now I want to take a look and show you how this comes to life in actual real executed campaigns. Okay, so this is an example of a direct mail piece that is used in auto refinance prospecting campaigns. So this is exactly what a recipient would actually see in their mailbox. You can see each piece is personalized using that variable data printing we talked about. It's highlighting a pre-qualified or pre-approved loan offer, and that's going to be tailored specifically to the recipients. So you're going to notice strong several calls to action here throughout the piece. Phrases like that, time is running out, refinance today, and start saving. There's also a clear offer amount and a rate example. You'll also see a limited time expiration, which you can see kind of highlighted in that yellow burst there on the right. That sense of urgency just encourages the recipients to review the offer and respond. Now, these campaigns are fully branded to your institution. They're going to be structured as compliant, firm offers of credit. So that's going to include any of that pre-screen required data and the opt-out language that you can see there on that left to the right. So while this example is a direct mail format, this same strategy and approach can easily extend into letters, statement messaging, email campaigns, and digital follow-up. So I'm going to take a look at a few of those in the next couple slides. So this example shows how that same targeting strategy can just be delivered either as a standalone personalized letter, or you can actually incorporate it directly as a statement cover letter. We do recommend for institutions that process statements with us to integrate that marketing message right into that statement cover letter or as an insert. When they're included, you actually benefit from them very high open rates. You also reduce the incremental postage costs, which, as we know, is often the largest expense in any mailing campaign. So basically, you're essentially just adding marketing without adding a full new mailing. So it's saving you all that postage. In this format, the marketing message does appear as a cover letter in front of the statement. But that actual statement is going to follow and all those pages behind it. So nothing is going to be replaced or lost. That statement just remains exactly as expected. It just follows on that second page. So the offer is still personalized. It's fully compliant. You're just leveraging an existing monthly touch point to your account holders that are already engaging with it. So same targeted strategy, just delivered through a more integrated and cost-efficient channel when you include it with your statements. So here's how that same offer can translate into an email campaign. So email actually allows for immediate delivery and very fast scaling. It's a very frictionless response path and often just with a single click. So you'll typically see stuff like call us, click here to apply, or a get started button like you see here. That's going to just directly to have the recipients try to get to that next step quicker. Email can work well on its own. It can also be layered, so you can put it alongside with that direct mail piece or in that statement campaign, just to kind of create that coordinated multi-channel approach. Of course, all required disclosures, compliance language, they're also all incorporated appropriately in the digital format as well. So now that we've kind of seen how these campaigns can be delivered across these channels, kind of let's go look into what goes into building one, just in kind of including the structure and the pricing of it. Okay, so pricing for credit prospecting is going to vary based on a few key factors. It's going to include the number of records purchased, the credit and demographic criteria selected, and any credit bureau minimum charges. There is also a one-time bureau setup fee that's going to be required just to establish access and get that campaign configured. But the good news is that getting started with credit prospecting is actually typically more affordable than most institutions expect. Most of them typically start around that $750 range for data, and then it scales from there just depending on the scope of the campaign you choose. So to keep planning simple, we do provide a complimentary list count and cost estimate before you actually launch. So you can evaluate the audience size, feasibility, budget, and you have no obligation. So I will have a link to click at the end if you do want to get some information on that. Criteria such as credit score ranges, geography, loan type, they can all easily be adjusted to align again with your goals and your budget. Even the most modest campaigns can generate significant loan growth when that targeting is done correctly. To put it into perspective, we had a recent credit union client. They ran a pre-screened auto refinance campaign. They targeted about 5,000 non-members. They used a simple letter and then a postcard touch over a 6-week period. That campaign generated over $5 million in new auto loans for that institution. So it's just a really strong example of how that precise targeting and that clear messaging can really drive measurable results and get that meaningful return on your investment. So now that we've kind of covered credit prospecting, I want to look at credit alerting, kind of showing how it compares and how the two can work together to kind of drive your lending growth. So credit prospecting and credit alerting are actually complementary strategies, but they actually work at different points in the lending journey. So I like to say the simplest way to think about the difference of the two is the timing of them. So credit prospecting is proactive marketing. It's going to target account holders and or prospects who already have a loan elsewhere or show strong potential to borrow. So the goal is to identify that qualified borrower earlier before they actually enter that lending process with credit prospecting. Now, credit alerting, on the other hand, is reactive marketing. So it's going to notify you when one of your account holders has applied for credit elsewhere, which signals that they are actively in the market for a loan. This is going to allow you to quickly respond to them with a competitive offer. In simple terms, I like to say that prospecting is going to actually build your pipeline, while alerting is going to capture immediate opportunity. I think many of our institutions at LKCS see the strongest results when they kind of combine both of them. Just supports that long-term growth while you're also capturing those short-term wins. But let's walk through step by step and just see how credit alerting works. Okay, so it's going to begin with a credit inquiry, which is a real signal of borrowing intent. Here's what's going to happen. So basically, when your account holder applies for credit anywhere, a credit inquiry is going to appear on their credit file, and those inquiries are going to be categorized by loan type, like your mortgage, auto, installment loans, or credit cards. Then your account holder database is going to be cross-referenced daily against those inquiries. So it's going to keep those leads timely and actionable. Then when a match actually meets your criteria, what happens is a qualified lead is going to be generated and delivered to your institution. That's what's going to allow you to respond while the borrower is actively shopping. And this is actually where timing is going to become critical for your institution. You're going to want to have a process in place to respond immediately with a firm offer of credit, just to increase your chance of winning that loan. So now that you've seen the kind of the basic process, let's look at how those inquiries are actually turned into qualified, actionable leads for you. So once that inquiry is identified, the focus is now going to shift to that filtering and qualification process. So you're going to select those inquiry categories you want to target, such as the mortgage, auto, credit card, installment loan, etc. And you're, again, going to maintain full control of that. Each lead is then going to be pre-screened using your qualification criteria, including credit scores, loan balances, debt values, risk parameters, all that good stuff. Then those alerts are delivered in a single file daily. So that's what's going to give your institution that full visibility into new opportunities. From there, that outreach can be handled internally by your team, or we can support you. We can do same-day direct mail, email campaigns. We can assist with outbound calling strategies. Again, if you do that outbound calling, you'll be in charge of that dialing. We'll just help with the scripting and campaign support. But it's important to note that the data is sourced from all 3 bureaus. That just helps kind of reduce missed opportunities and just ensures that broader coverage that you guys want. The result, though, is going to be speed and precision, just allowing you to reach borrowers before your competitors do. So now that you've seen how credit alerting works, let's look at that cost structure and how institutions typically budget for that. So credit alerting is basically, the pricing is going to be based on usage, meaning it's going to scale based on the number of account holders and or prospects that are being screened each month. So it gives your institution flexibility. You can adjust volume based on demand, maybe seasonality or staffing capacity without having you be locked into those fixed thresholds. There is also a one-time bureau fee required here as well, just like in prospecting, just to kind of get that program configured and get that access to that data. But most credit alerting programs typically start around $1,600 a month. So just depending on how you scale it and the size of the account holder base that's being screened. Again, to help you evaluate if the program makes sense for your institution, we're going to offer that complimentary opportunity analysis with credit alerting. So we'll actually be reviewing your account holder credit activity from the past 30 days just to identify where lending opportunities may exist for you. From that review, we're going to provide several insights for you. First, we're going to look at credit activity by inquiry type, such as the mortgage, auto, installment, or credit card. We're also going to provide a breakdown by state and credit bureau, so kind of helping you see where inquiries are occurring and what bureau is reporting the activity. And then finally, we're going to estimate potential qualification and lead volumes based on your specific lending criteria. So this just is going to give your team a clear picture of the opportunity. It's going to allow you to just evaluate that lead volume and return on investment before actually launching a campaign. Again, I'll have that link at the end too if you're interested to get more information on that. Okay, so we just talked about how credit alerting helps you act quickly when members are actively shopping for credit. Campaign Suite is going to focus on something a little bit different. It's about staying visible throughout the borrower's decision process. So one of the ways institutions have traditionally done is through direct mail, we know, which direct mail still remains very effective. But today's borrowers, they live in both that physical and digital world now. So interestingly, that resonates strongly with Gen Z. They often view physical mail as more personal, especially in our increasingly digital world. Actually, in a recent market reach study, they found that 72% of Gen Z respondents said that they would be disappointed if they no longer received physical mail. So today's borrowers rarely respond after that one touch, and that's where I think Campaign Suite comes in. It's going to connect these two experiences. So it's going to take that direct mail campaign, it's going to extend it digitally and just reinforce that same message across additional marketing channels for you. So instead of relying on one single touch point, you're going to create one coordinated campaign with multiple touch points. These can include what we discussed, that direct mail, online follow-up display ads, and also social media and digital display through platforms like Google and Facebook. That result's just going to give you a seamless coordinated campaign, increase your visibility, increase your engagement, and your response rates just compared to direct mail alone. Okay, now let's take a look at how that connection actually happens behind the scenes. Okay, so this is where a campaign continues working in the background. Think about when you're shopping online. Maybe you're looking at a pair of shoes on a website like Amazon. You don't buy them right away. Later that day, you open up another website, or you're even scrolling through your social media and you start seeing those ads for that exact same pair of shoes. That's not a coincidence. That's retargeting technology at work. So Campaign Suite actually works the same way, but it's going to follow up automatically through digital ads. So after someone actually visits your website. Basically, when a direct mail recipient visits your website, tracking technology is going to activate and a cookie is going to be placed on their browser. So platforms like Google and Facebook are going to recognize that visit. And then after they leave your site, they're going to begin seeing those digital image ads. It's just going to reinforce that campaign message, that branding for you. It's going to keep your institution visible. It's going to keep it top of mind while that borrower is still researching their options. I think the goal is just pretty simple. It's just staying present until that individual is ready to take the next step, which that next step might be filling out a form, starting an application, or reaching out directly to your team. But the key benefit is going to be that automation. Your team isn't manually managing follow-up. The system just continues reinforcing your message until the borrower is actually ready to act. Let's take a look at what that experience actually looks like from the borrower's perspective. Okay, so think of it this way. The tracking and automation are the engine, but that branding and messaging are what your audience actually sees. So you can see on the left here, you see that personalized direct mail piece. And on the right, you're going to see how that same creative and messaging extends into those digital ads. The visuals and the branding remain consistent across those channels. That includes those platforms like Google and Facebook. But that consistency is intentional. It's just going to create familiarity. It's going to, instead of feeling random, it just helps build that trust as borrowers kind of move through their decision process. So basically, instead of running those separate campaigns, Campaign Suite's going to help you extend into one cohesive strategy. It's going to move that experience from the mailbox to that online engagement. Let's zoom out and just look at how the full journey is going to work together. Okay, so here's what the journey actually looks like in practice. So it's going to begin with that personalized direct mail, so delivering those targeted credit qualified offers to the right recipients. After receiving the mail piece, recipients are then going to visit to learn more, which is going to trigger that next step. That visit actually activates automated digital follow-up, where those coordinated display and social ads are going to reinforce your campaign's branding and your messaging. This is what's going to keep that institution visible after that initial touch point. Finally, conversion is going to happen when the individual takes action. So whether that's completing a form, starting an application, or reaching out directly to your team. But again, rather than running separate campaigns, you're just creating one coordinated experience across mail and digital, just having it work together automatically. The result you're going to see is that consistent visibility, that stronger engagement, and just a clearer path to conversions, especially for lending decisions that rarely happen after just one interaction. So that's basically how Campaign Suite works together. Now let's talk about what that means for your results. Okay, so when a direct mail is combined with coordinated digital follow-up, campaign performance increases measurably. Retargeted visitors are up to 70% more likely to convert because your message is staying visible throughout their decision process. So even if someone doesn't act immediately, those follow-up ads are just going to keep reinforcing your message. In fact, over 26% of users return to a site after seeing retargeted ads. So that's just creating that additional opportunity to turn their interest into an application. The reality is most borrowers don't act again after that first touch. So combining the mail with the digital follow-up, you're just going to extend that life of that campaign and capture those opportunities that mail alone might miss. So beyond the numbers, what does this mean for your institution? It's going to come down to 3 key benefits. So this is actually why Campaign Suite works. First, you're going to see higher return on your investment. By combining that direct mail with your coordinated digital follow-up, you're going to extend that life of the campaign and you're going to maximize that impact of every marketing dollar. Second, you're not going to leave any leads left behind. So basically, not everybody responds that first time to that offer they see, we've realized. but that automated Google and Facebook follow-up ads are going to keep your message visible after that mail is delivered. So it's just going to reinforce that offer until, again, that recipient is ready to act. And then finally, that higher response rates, that consistent messaging across both mail and those digital touch points, it's going to build that familiarity. It's going to build that trust. Just going to build momentum over time, which is just going to drive stronger engagement and more applications compared to just mail alone if you did that. So you can kind of see together how these channels create one coordinated experience, just keeping your institution visible throughout that borrower's decision process. This approach is really powerful for credit prospecting and credit alerting, where that timing, that repetition, and that visibility are often determining who ultimately wins the loan. Okay, as we wrap up today, I just want to bring it kind of back to where we started, that you can't afford to let those great loans slip away. The institutions that we see the strongest growth, they aren't waiting. They're identifying those qualified borrowers earlier. They're delivering personalized, compliant firm offers of credit, and they're staying visible throughout that entire process that the borrower is going through. So again, if you're curious what this could look like for your institution, the next step is pretty simple. Let's take a look at your numbers. So again, we're happy to run that complimentary list count or cost analysis so that you can see the opportunity firsthand. And again, no obligation. Just click on the link on the screen or scan that QR code to get started. Thank you so much again for your time today. I'm going to open it up now for questions. If you have any, go ahead and just type those in that question panel now. Thanks again, everybody.